With Mr. Indrajit Agarwal, who is the Senior Research Analyst and particularly covering materials. Hi Indrajit, very good morning, good afternoon, and thank you so much for your time. First of all, since we are interacting on the sidelines of the conference, first up, help us understand that what have been your key takeaways and what have been the key takeaways for the India materials as a sector. What's the view coming in?
So if you look at the sector, what has happened in the past few years and also year to date, we are in the midst of a structural upcycle driven by all the levers, be it infrastructure, housing, property market, whatever you call it. However, the last 6 months effectively has been a perfect storm. We have had a confluence of 3 events which has led to a significant weakness in the demand environment. First and foremost, we had the elections, which clearly is generally led to a softness in demand. Second, monsoons were harsher and much more extended, which led to a slowdown in construction activity. Third, the overall weakness in consumer sentiment. All that has led to a much softer demand across materials category, be it cement, be it building materials. But I think we are poised for a very strong second half, even on a stronger base. As prices stabilize, as demand picks up again, government capex picks up again, I think the upcycle that we had seen in demand is likely to take off soon in the following few months.
All right, but Indrajit, since we are just out of the earnings season, so how do you assess the Q2 earnings for the sector as a whole, and how is the second half of the year is expected to pan out and perform?
So if you look at the second quarter particularly, it has been marred by 2 key things. One, we have seen demand weakness. Overall, if I look at cement, demand would have fell by close to a low single digit. Steel would have held up slightly better. But other than that, most of the building materials, pipes, wires, most of the consumer facing or infrastructure facing segments has seen softness in demand. In addition to that, volatility in input costs, copper, aluminum, PVC has led to softness in margins, and soft demand has meant that profitability could not be improved by passing on the higher prices to the consumers. As we head into second half, while October, as we understand, has been soft, given both Dussehra and Diwali fell in the same month, November onwards we should see demand picking up. In addition to that, with improved demand and some bit of price uptick in few commodities, earnings would likely to be better sequentially, but nothing blockbuster as yet. I am more hopeful of FY26 to be a much stronger year as a whole rather than the second half of FY25.
All right, but Indrajit, another point that I wanted to ask you is that how do you view the China factor and its impact on the global commodity market? Because Chinese stimulus measures have not lived up to the expectations. So I wanted your thoughts on whether the Chinese economy is headed and its impact on the global commodity market. How do you foresee this?
Good question and very relevant at this point in time. I would break it down into the ferrous, that is the steel space, and the non-ferrous, that is the base metal space. If I look at ferrous particularly, without a strong sustaining stimulus in China, which has so far been absent, and without an uptick in property market, we think that ferrous space could remain challenged for the near term. There is significant amount of overcapacity in China. Currently, the exports are clocking close to 80 million ton annualized, very similar to what they did in the gluts of 2015-16. This would keep regional and global spreads lower for longer and would weigh on profitability of Indian steel companies as well. As a house, we think that the stimulus are just the first step in that direction. As we head into the next year, we could see more stimulus measures, and that could lead up to a very strong demand environment. But till the time that actually fructifies on ground, we are unlikely to see steel spreads improving. On the other hand, if I look at base metals, particularly aluminum, demand-supply balance, while it is more or less balanced, the cost support is significantly more there. We continue to see sporadic disruptions in the feedstock, be it bauxite or alumina. That led to costs curve moving up. In addition to that, over the weekend, the announcement by China to curb exports of aluminum could also lend support. So net-net, we are more positive on the non-ferrous space than the ferrous space. And overall in the material sector, we would prefer more inward-looking companies which are more exposed to domestic demand than things which are linked to China in terms of commodity spreads.
All right, so for now, more positive on the non-ferrous space versus the ferrous space. But Indrajit, how do you view the impact of the macro challenges of inflation, slowdown in urban consumption on the domestic appliance industry? And do you believe that the medium-term story remains intact?
No, I think if you look at penetration level for most appliances in India, it is significantly much lower than what we have in global averages. We tend to compare a lot of times with China, but even if you look at some of the other emerging economies, be it Indonesia, Mexico, India's penetration in most categories is much lower. That gives you a long runway for growth. In addition to that, what we are seeing is the per capita income is rising gradually, and the current per capita income of close to $2,000, $2,500 is where we generally see the inflection point and leads to an uptick in the consumption of these commodities. An interesting trend that we are seeing in most of the appliances categories today is a trend of premiumization, where premium categories are doing much better. Pick any category, be it televisions, refrigerators, washing machines, air conditioners, even so much so as water coolers. So companies which are more focused on premiumization are likely to do much better, and that is a trend we think is going to keep picking up as the aspiration of the middle class rises.
All right, Indrajit, but before we let you go, also wanted your thoughts on the intensifying competition and the consolidation in the cement sector, because prices have barely moved higher over the last 7 to 8 years. Wanted your thoughts on the cement sector over the medium term, especially for the top 5 players.
I think if I break it down into 3 aspects, the volume growth, pricing and costs, I think volume growth for the larger few players will consistently be much better than the smaller players. The larger players will continue to gain market share, not just by way of consolidation, but also organically, because they will continue to expand their reach. However, on pricing, what we are observing is absolutely correct. In the last few years, we have hardly seen price increase. But if you look at the last 15-20 years, cement prices have always grown much lower than inflation. Last 20 years, average cement price increase has been 3.5%. And profitability improvement has been more driven by cost savings. As a house, we believe that is going to happen in the next few years as well. There are 3 or 4 levers of cost savings. One is higher renewable power usage. Second is lower lead distances. Third is improving the mix of cement, etc. All those things will lead to profitability improvement. And in an environment where the top few players are focusing so much more on both cost savings and market share gain, pricing would be very difficult to come by in my view. And that is where larger players, where we have a better volume growth visibility and cost saving outlook, are likely to fare much better than the smaller or regional players.
All right, Indrajit, with this, we'll let you go on that. Thank you so much for joining us today. So that was the materials analyst of CLSA, where we interacted with him on the sidelines of 27th CITIC CLSA Forum. But
if you like this video, then like, share and subscribe to ET Now.